It's the U.S. stock market. All right, I can do this. The U.S. stock market, if you have something like 10 or 20 or even $50,000, all of this detail is doable, I think. Yeah, I think you could do this with as little as like 30 something thousand dollars. I don't think it's worth the hassle. So under 50, just put it in the Vanguard Total Stock Market Index. Don't worry about it. Your big problem is that you have $50,000. Keep adding money. That's your goal. Add money, add more money, add more money. And if the market's down, great. You're buying on sale. If the market's up, bummer. But in the long run, it's going to be even higher. So keep adding. Again, long-term maximum returns suggest that you put the money in as fast as possible, yesterday if possible, as early in the year as possible, and you ignore all the craziness. Don't look at your portfolio every quarter. For God's sake, don't have on the ticker feed that shows how much the market is going up and down every day. It doesn't fucking matter. You can't do anything about it. And history shows that trying to do something about it generally ends up backfiring, and you're flashing around, slashing around, jumping around, I don't know, flapping around. That's what I want, like a fish in a boat. You can struggle all you want, but you're not going back in the water. So the U.S. stock market, I break down into 6 segments, and this is something I came up with. Others might use it, I don't know, but they're not sectors. Sectors would be like banking, industrial, retail, things like that. These are segments of the U.S. market. There's 6 of them: large cap growth and value, mid cap growth and value, small cap growth and value. To my knowledge, the only place you can do this at this time is at Vanguard with Vanguard index funds. Other companies have really good total market or S&P 500 index funds. And again, if you have a smaller portfolio, using any one of those is fine. Maybe Fidelity has all 6 of these funds. I just may not be aware of it. It could also happen at Schwab or some other place. And again, I'm just not aware. If you know of it, send me an email, phil@polarisfinancialplanning.com. And of course, I can talk about it here. So those 6 segments of the U.S. market, I used those because all 6 of those segments in the long run, 10, 15, 20 years, tend to make about the same amount, 10 to 11% per year. Maybe in the next 20 years, that average is 9%. Maybe it's 12%. I don't know. But it's way better than the 2 or 3% you're going to get in stocks if you have the time to wait for it to do what it does. And in those 6 segments, I look for, what do we call it? Discrepancies. I look for 1 or 2 segments outperforming or 1 or 2 underperforming, and that creates an opportunity for me. The reason I do that is my acceptance of the idea of regression to the mean. And again, history shows that all 6 of those segments return about 10% per year in the long run. And I have nothing better than to assume that they're all going to return 10% per year on average in the long run. Additionally, when one of those 6 segments has a particularly bad period, whether it's a year or 5 or 10, it tends to do better going forward to kind of approach that mean of 10%. And sometimes this allows me to make 1 or 2% adjustments in the portfolio. And this is why part of this won't work for a $50,000 account, because the adjustments are so small that even if you're right, it's not going to have any real advantage. Again, your goal is to save more money. And from time to time, I switch things around because the economics of the U.S. market are different. Interest rates are different. As an example, in the really long run, the last 100 years, value stocks have done better than growth stocks. Small caps have made more with more volatility than large caps. However, in the end, my goal is not to avoid volatility. In the end, my goal is to have the highest, biggest portfolio when I get to retirement. In the last few years, large caps have outperformed small caps by a lot. Growth has now outperformed value by a lot. And so over the last couple of years, I've made small adjustments away from large cap and away from growth towards value and towards small cap. I am doing that again. So if you've followed the charts, if you've listened to the show regularly, none of this will surprise you. So what I am suggesting now, even though large cap stocks in reality make up 75% or more of the US market, I think you should have 50% in large cap, 50% in the S&P 500, and it should be 22% large cap growth and 28% large cap value. If the market keeps doing what it's been doing, this could be a pretty stupid recommendation. If the market changes at some point in the future, and history is full of changes, this could be a pretty clever idea. So take it with a grain of salt. I don't know the future. I just know that there are periods of time, sometimes 3 to 5 to 10 years, where value wins, and then there's longer periods of time, or different periods of time where growth wins. We've now had a period of time where growth has outperformed value by quite a lot for quite a long period of time. As an example, over the last 10 years, and this is based on the large cap growth fund from Vanguard, VIGAX is the symbol, it has made 12.4% per year over the last 10 years. But the value fund, the large cap value, VVIAX, has made 8.6%. So that's a spread of almost 4%. You would have made 4% more per year over the last 10 years being in growth versus value. Again, these numbers are from March 31st, from those specific Vanguard funds. I don't pull this up every day, but 4% per year over 10 years compounded is a big freaking difference. So it's not just 40 times or 4% times 10 or 40% more. It's probably 50 or 55 or 60% more. So being in large cap growth stocks, and we know the names, Amazon, Microsoft, Facebook, Apple. If you've been in those stocks, if you've been in S&P 500 funds or specifically large cap growth funds, you've crushed it. Congratulations. Now the question is, what does the future hold? And I'm pretty confident that the markets will adjust back to what their normal pattern is. And ironically, the long-term normal pattern is that value stocks do better than growth, but it hasn't happened in this last decade. So half of your money in the S&P 500, the other half in the extended market, mid-cap, small cap, however you want to call it, depending on what your options are. Maybe if the bulk of your money is in a 401k, you can only see the S&P 500 and maybe you can only see the extended market. So then 50-50, right? That's really easy. But if you can use these 6 segments, I want half in large cap, 28% large cap growth, 22% in large cap growth, 28% in large cap value. I know it's a difference of only 6%, and these are the big adjustments that I make, but because I don't know the future, I don't want to put it all in value and then be wrong for 5 more years and miss out on all the large cap growth. You can always readjust every year. Now, the remainder, about 50%, is going to be in the extended market. And at this time, I'm going to say 25% mid cap and 25% small cap. So if your portfolio, your 401k only has S&P 500, a mid cap index and a small cap index, then you can do 50, 25, 25. And you're going to be in the right ballpark. But if you can break it down to a greater level of granularity, in the mid cap, I want 10% in mid cap growth and 15% in mid cap value. Small cap, 10% in small cap growth, 15% in small cap value. And what is driving this? And again, I'm going to give you these numbers as of 12/31 of 2020, which is already a month old at the time of this recording. And you may hear this in a year or two. So just keep in mind things change. But the 1-year performance as of March 31st, large cap growth is up 1.3. Large cap value is down 15%. That's a 16-point variance. Mid cap growth is down 11, but mid cap value is down 23. Small cap growth is down 16, but small cap value is down 30. Now, Again, these are the 1-year numbers, not the year-to-date numbers for 2020. The 1-year numbers ending 3/31 of 2020. So go back 12 months in time. And so this provides an opportunity to, if you're doing nothing else, rebalancing is something you should do every year. You could also consider rebalancing more often when there's extreme differences, because now your portfolio is out of whack even though it hasn't been a year. And if we have definitely had some significant volatility so far in the year 2020. So that's kind of the breakdown, just to make sure I give all the funds. What I'm going to do here, I've got to zoom in. Sorry about the beep there. I've got to zoom in, and I'm going to read off the 6 funds that I use for the U.S. stock market. First is large cap growth. I've mentioned it, VIGAX. Next is large cap value, VVIAX. And then we go to mid cap growth, VMGMX. Mid cap value, VMVAX. Hopefully you're not driving, because this would suck. You can't write this down. I hope you're not trying to write it down when you're driving. Small cap growth, VSGAX, and small cap value, VSIAX. And so those are the 6 funds that I use. My current recommendation as of today is large cap growth 22%, large cap value 28%, mid cap growth and value 10 and 15%, small cap growth and value 10 and 15%, with the emphasis on the value. How you get there can be very complicated because taxes might be involved, or it could be phenomenally simple if virtually all of your money is in an IRA. And even if you have a lot of money in a taxable account, if you can add money, you might be able to get close to these ratios or make the adjustments or the rebalances with your new money. So that's a lot of numbers, a lot of information, and my thoughts on what I call the U.S. market matrix, the United States stock market only, following my style of breaking it down into 6 different segments. If you want more detailed information, or if you want me to look at your portfolio or even the funds that are available in your 401k, you may email me, phil@polarisfinancialplanning.com. And please, in that first email, do not send your social security number. Do not send any attached documents or investment plans. Do not send your address. When I have a little bit of respect towards privacy and piracy on the internet, once we talk by phone, so please include your phone number. That's the one thing I will encourage you to include. I'll call you and make sure that the email you sent actually got to me. We'll talk a little bit, and if it's still relevant, then you can send documents later and we can go over that. That is something that is available to you because you're listening to the show. So hopefully some of you will take advantage of that. If I can be of help, fantastic. That's no charge, nothing expected. Keep in mind, sometimes I miss emails. Sometimes they go to the spam folder and I lose them. So please feel free to remind me after a week or two if I didn't respond to you. And boy, that was a lot longer than I expected. So hopefully some of you found value in that.